Hey everyone, welcome back to The Explainer. Today, we are straight up putting on our detective hats. Think of me as your investigative older brother for the next 10 minutes or so, because we're diving into an absolute masterclass on how to see right through the numbers. We aren't just going to casually glance at balance sheets today. No, we are going to interrogate them. Because look, here is the harsh reality of the markets. Even the smartest, most seasoned Dalal Street and Wall Street analysts routinely get fooled by basic accounting tricks. Today, we're going to change that. I want you to transport yourself back to the year 2009. The company is Satyam Computers. At the time, they were an absolute titan. We're talking about a top 5 Indian IT giant pulling in 40,000 crore in revenue, backed by an army of 50,000 employees. The sheer scale of this company just made it feel completely invincible. But then, on January 7th, the chairman Ramalinga Raju dropped a massive bombshell. He openly admitted that for years they had been completely cooking their books. So the big question is, could we, everyday investors putting our hard-earned money on the line, have actually seen this coming before the whole thing collapsed?
Well, the answer is a massive, resounding yes. The chairman admitted to a staggering 7,800 crore rupees in fictitious profit. I just want to pause for a second so that really sinks in. 7,800 crore. That money simply never existed. Unsurprisingly, the stock absolutely cratered, crashing 90% almost overnight. So to make sure you never get caught in a financial crime scene like that, today we're arming you with a legendary detective toolkit. We're going to use Howard Schilit's famous framework for spotting financial shenanigans.
Okay, let's dive right into this. Here's our whiteboard syllabus for today's explainer. 1. The illusion of earnings. 2. 7 accounting shenanigans. 3. 5 cash flow red flags. 4. Indian fraud case studies. And 5. The 10-point quality check.
All right, starting with Section 1, the illusion of earnings.
Let's lay down the absolute foundation of our investigation today. We really need to understand a core theory known as earnings quality, because as it turns out, not all profits are created equal. Companies are under this immense, relentless pressure from the market to meet their quarterly targets, and when they can't meet those targets legitimately, they often resort to creating an illusion. Now, high-quality earnings, that's exactly what you want to see. It means the profit is predictable, it's recurring, their accounting policies are conservative, the audit is clean, and most importantly, the cash actually matches the reported profit. Low-quality earnings, on the other hand, are that manipulated illusion. They're totally disconnected from real cash, highly unsustainable, and usually rely on cheap, one-time tricks. Howard Schilit literally wrote the definitive book on this, mapping out the forensic footprint of how companies manufacture these low-quality illusions.
Moving on to Section 2. 7 accounting shenanigans.
So, these 7 techniques are the specific sleight-of-hand tricks companies use to pull the wool over investors' eyes. The first 2 are straight-up revenue manipulation. Technique 1 is recording revenue too soon. Imagine a software company booking the entire payment before the service is actually finished and delivered. Technique 2 is even wilder, recording totally bogus revenue from fake transactions. Satyam did exactly this. They meticulously forged fixed deposit receipts to create fictitious customers and fake bank balances out of thin air. As a forensic investor, your red flag here is if receivables are growing way faster than revenue for several quarters. Or, and this is a big one, if a company claims to have a massive cash balance but is inexplicably taking on more debt. Come on, that completely defies logic.
The next group is basically a shell game. It's all about shifting the burden. Technique 3 is boosting income with one-time gains, like, say, selling a piece of real estate, but deceitfully passing it off to investors as normal operating profit. Technique 4 is hiding current expenses by shifting them to the future. They do this by capitalizing costs, essentially treating a daily operating expense, like buying printer paper or doing basic maintenance, as a long-term asset just so it doesn't hurt today's profits. And Technique 5 is failing to record liabilities. A prime example here was IL&FS. They notoriously hid massive amounts of debt in special purpose vehicles, or SPVs. To put it simply, an SPV in this context was just a shadow company created specifically to hide toxic debt off the main books, keeping the parent company's financials looking squeaky clean.
And this brilliantly illustrates Technique 6. It's about manipulating operating income, very often through a trick called the big bath or kitchen sinking. You will see this all the time when a new CEO takes over. They'll suddenly load up on provisions, aggressive write-offs, and basically pull all future expenses into their current quarter. They take a massive, intentional, completely manufactured loss early on. Why would they do that? Because the market has a psychological trap. Investors absolutely love a turnaround story.
By taking a big bath today, the new CEO basically guarantees that every single quarter after that looks like a miraculous, highly profitable recovery. It's just a total manipulation of the timeline.
Finally, Technique 7 focuses on artificially inflating inventory or receivables. A super common, highly destructive way this happens is through channel stuffing. This is when a company artificially inflates its sales figures by shoving way more products down a distributor's throat than they can actually sell. They usually pull this off by offering massive, completely unsustainable discounts right before the quarter ends just to hit those executive sales quotas. It creates wildly fluctuating demand, a massive backlog, and eventually a devastating crash when those distributors inevitably return the mountain of unsold goods.
Let's jump to Section 3, 5 Cash Flow Red Flags. Now that we know how they manipulate the income statement, we have to learn how to spot the lies on the cash flow statement. Because listen, while profit is an opinion, cash is a hard fact. Here are Schilit's 5 cash flow warnings. Number 1 is literally the biggest warning sign of them all, when reported profit is consistently greater than cash flow from operations. Remember, profit is an accounting concept built on assumptions. If it's not converting to cold, hard cash in the bank, that's a massive red flag. Number 2, look out for declining cash flow even when revenue is supposedly growing. Number 3, the constant heavy use of exceptional or non-recurring items every single year. Number 4, aggressive working capital games, like suddenly ballooning receivables. And number 5, hiding liabilities in complex off-balance sheet entities. Which brings us to Section 4, Indian Fraud Case Studies.
All right, theory time is over. Now it's time to actually apply our toolkit to some real-world crime scenes right here in the Indian market. Let's go back to our first crime scene, Satyam in 2009. If you had applied Schilit's framework back then, the alarm bells would have been completely deafening. First off, they reported over 5,000 crore in cash, yet they kept taking on debt. Ask yourself, why borrow money and pay interest if you are swimming in cash? Second, the promoters were quietly selling off their own holdings. That's a clear sign of insider knowledge that the ship is sinking. And third, they tried to push through a highly suspicious related party acquisition of a company called Metas. The forensic signals were all flashing red well before the crash.
Next up, Manpasand Beverages in 2018. These guys were boasting 25% plus annual revenue growth in what is otherwise an incredibly stable, fairly boring juice industry. Your forensic instinct should immediately jump to, okay, that's too good to be true. But then came the final nail in the coffin. Their auditor, Deloitte, suddenly resigned just days before signing off on the financials. So the crucial point is this: an auditor resigning out of nowhere is a nuclear-level red flag. The reality behind the scenes, they were engaging in severe channel stuffing to fake that crazy growth. The stock eventually fell 99% and became essentially worthless.
Let's move over to the banking and finance sector with Yes Bank and DHFL between 2018 and 2020. With Yes Bank, there was a glaring gap between the non-performing assets the bank publicly disclosed to investors and what the Reserve Bank of India actually found during their inspection. Guys, a regulatory disclosure gap is an immediate warning to run for the exits. Plus, the promoter flatly refused to step down despite huge pressure. Then we have DHFL. Investigative reports revealed 31,000 crores in round-tripping. If you aren't familiar with that term, round-tripping is basically sending money out as a loan to a shell company only for it to be routed right back in to artificially boost your own revenues or hide bad loans. It's just a closed loop of fraud. They issued massive related party loans to the promoter's other companies, and their cash flow was completely disconnected from their stated profit.
Let's wrap up with Section 5, the 10-point quality check.
So how do you actually protect yourself from stepping on these financial landmines? Here is your ultimate survival guide. You can use this rapid-fire 10-point checklist to analyze the forensic health of literally any company before you invest a single rupee. Let's walk through it quickly. First up, cash conversion. Is cash flow from operations at least 90% of net profit? Second, are receivables growing faster than revenue? Third, is the day's inventory outstanding bloated, meaning stock is just sitting in warehouses? Fourth, is other income making up more than 10% of the total profit? Fifth, are so-called exceptional items conveniently happening every single year? Sixth and seventh, have the auditors suddenly changed or issued a qualified report expressing doubts? Eighth, is the promoter pledging more and more of their shares to get loans? And finally, 9 and 10, are there massive related party transactions or huge hidden off-balance sheet disclosures? Grade the company. If they score 8 or more green lights, it's a pass. If it's 5 to 7, you need to deeply investigate. But if a company has fewer than 5 green lights, you simply avoid it.
Now, to successfully run that 10-point check, you need the right tools in your belt. Use Screener.in to quickly spot sudden auditor changes and weird related party transactions. Use Tajori Finance for brilliant visual breakdowns of their historical financials. Money Control's great to compare their metrics against industry peers. But most importantly, you absolutely have to go directly to the exchange filings and read the auditor's report fully. Look specifically for a section called Key Audit Matters. Why? Because this is essentially where the auditors cover their own behinds legally. If they suspect management is making highly aggressive assumptions, they will flag it right there in the Key Audit Matters.
Spotting accounting manipulation is your shield. It's how you ensure the foundation of the house is solid. Because once you know the numbers are real, you can finally move on to the fun part. That's exactly why, in our next explainer module, we are leaping from the defensive forensics of accounting right into the beating heart of investing, valuation. We'll be stepping into Aswath the Motorin territory, breaking down the absolutely crucial difference between price and value, and understanding the margin of safety. You really won't want to miss it.
The market is full of illusions, but with the right framework, you can see right through them. Keep questioning the numbers, keep demanding cash-backed evidence, and keep learning. The numbers rarely lie, but the people writing them, they often do. So ask yourself, before you make your next investment, are you buying a fundamentally sound, truly profitable business, or are you just buying a masterfully crafted illusion? Subscribe to the channel. Market Seco, Sena Mayao. I'll see you in the next explainer.